Good morning, everybody. I'm back on YouTube. I've been away for a few days. I've been in Northern Ireland at the first Heritage Party Northern Ireland conference, which was a fantastic event. But while I was there, current events just continued to take place at great pace. And there's 20 or so different things that are really affecting life and society at the moment. You could list them all, but one of the big things at the moment is the financial crisis that is going on, the banking crisis, and how that is affecting the economy. And of course, this is going to affect the lives of ordinary people and small and medium-sized businesses if it continues to go on and escalate as it seems to be doing. So I made a video about this a week or two ago because we all have heard of this Silicon Valley Bank which collapsed, and that was, I think the date was the 10th of March 2023 that collapsed. But that was after another bank called Silvergate, and then another bank after it called Signature Bank also collapsed. Three banks in 1 week. And then last week, while I was in Northern Ireland still, Credit Suisse kind of went under, but they got rescued by being bought out by a bigger bank. Now, they have been on the rocks for a very long time. I mean, I was flagging this up last year, and a lot of other people were, because they basically had not got the assets to cover their liabilities, essentially. So people have known about this for years and years. So it was going to go down anyway at some point, and this happened last week. But what happened there, instead of it crashing and going bankrupt, it was bought out and taken over by another large bank, which now has a lot of its liabilities for itself. So UBS, you probably heard this in the news, UBS, the only bank in Switzerland that is bigger than Credit Suisse, took it over. And what has happened with this, however, is that a lot of people have lost a lot of money. So the people that are called bondholders have lost all of their money. So anyone who had a Credit Suisse bond, the value of those bonds has just been written off as zero. So $17 billion of so-called assets have been written off. Now, I don't have any bonds. Bonds are things that normal, ordinary working people don't really get involved in. This is they are instruments that banks use with each other, and big investment companies and pension firms, and maybe a couple of really what you call high net value investors, individuals who've got tens of millions of pounds to put here and there and move around the world, might buy bonds. So, to normal people, you thought, well, what is a bond? People are talking about bonds all the time. What are they? Well, they are essentially notes issued by a company. Can be a government, but also a company or a bank, can issue their own bonds. So they're essentially IOUs. So they would issue a bond. Say a company issues £1 million of bonds. Maybe they would issue probably lots more billions of pounds of bonds. Other people would buy them, and then the bank, like Credit Suisse, that has issued the bonds, obviously promises that they will pay interest on the bonds. So I might buy, I don't have £1 million, but if I had £1 million, maybe someone who's a financial advisor would say, well, buy £1 million of Credit Suisse bonds. It's a good investment because they're going to give you 6% interest back every year. So you think, okay, that's great. I put my £1 million into Credit Suisse bonds. say it's a 10-year bond, so I get that £1 million back in 10 years, and then every year in between I would get £60,000, 6% interest, if it's a 6% 10-year bond. And the reason for doing that is that they pay a lot more money than you would get from just a normal deposit account, because deposit accounts in banks pay really, really low interest. I mean, for the last 5 or 10 years, the rate of interest on bank accounts has only been 0.1%, 0.1%, if that. So bonds might give a much, much higher rate of interest, which is why people buy them. But they're higher risk, supposedly. But with Credit Suisse, then these bonds have just been written off. So anyone who has invested in a Credit Suisse bond, it's gone. They've got nothing. That's £17 billion of money, value, investment just gone. So I don't have any, and probably you watching don't have any, but there's a lot of people who are very annoyed about this. But that is the price that has been paid because Credit Suisse was in a lot of trouble and it's gone under. But it hasn't gone totally bankrupt, so the depositors' money is still safe. And the thing is, when a bank crashes and it affects ordinary people, like you and me, or small businesses and medium-sized businesses will only engage with banks usually as on the level of being a depositor, or you might get a mortgage from a bank, etc. But normally you're a depositor. So if a bank goes under, how it affects ordinary people and small and medium-sized businesses is all the deposits will be gone. And then you might get a little bit of that back if it's protected under a government protection scheme. So in the UK, we have the FSCS, the Financial Services Compensation Scheme. And that says if you've got less than £85,000, so up to £85,000 in a deposit account in a bank, then that's protected and you should get that back. But there's a catch to that, you see, because a lot of people, or a lot of businesses, small and medium-sized businesses in particular, they rely, of course, on their bank accounts, and a lot of them, they're struggling. They don't have a lot of assets and so on, but they might have over £85,000 over that limit in the bank account because they need their cash flow, and then that goes up and down because money comes in, but then money goes out to pay the suppliers and to pay wages for their staff. And so if there's a point in time where a small business has £200,000 in a bank and it goes under, they're only guaranteed £85,000 of that by the compensation scheme. The rest is gone and they're never going to get it back, whether there's a compensation scheme or not. And the depositors are at the back of the queue. So if a bank goes under, normally the bondholders get their money back first. Now, this didn't happen in the case of Credit Suisse because it didn't go under, it was taken over. If it had gone under, they would have got their money back first, whatever was there. Probably there wouldn't even be that much money there for all the bondholders anyway. But something different happened in this case. Then the next people to get their money back are the shareholders, and then the poor ordinary people, the depositors, are at the back of the queue. And by the time anything gets sold off and paid back to either bondholders, shareholders, or depositors, there's nothing left for the depositors because they're at the back of the queue. The money is gone. So if you got your money in a bank as a depositor and it goes under, it's very unlikely that you're going to get any of that back if it's over the limit guaranteed by the compensation schemes. The United States has a little bit of a higher limit than the UK. Their guaranteed limit is $250,000 rather than £85,000. So, if you do have more than that, it's a good idea to spread it around a few different banks. So, get 2 or 3 different accounts with different banks, and don't keep more than that limit in each particular bank, because then they're guaranteed separately. That's one way of trying to make sure, limit your risk in the age where banks are going under. But you see, so Credit Suisse is the fourth bank here that has either gone down or has had to be rescued. So they put this rescue package together. But of course, the media moves on, interest moves on, attention moves on, and now the next bank under fire is something called First Republic. Everyone's talking about this bank as well. So this is a larger bank in the United States than Silicon Valley Bank. Silicon Valley Bank was the 16th largest bank in the USA. First Republic is the 14th largest bank in the USA. And the problem that has is that people are already looking at it. People have already been looking at this for a number of weeks and thinking, this might go under, so I'm going to withdraw my money out. So a lot of depositors have just removed their money, particularly depositors who have got over $250,000, the compensation scheme limit. A lot of them are withdrawing their money, so these are high net wealth individuals and medium-sized businesses who have got a lot more than that limit, and they're pulling their money out and trying to put it somewhere where they think is safer. And maybe, the perception for them at the moment is what they're doing is they're pulling their money out of these smaller banks that they think might go under and putting them in the larger banks like JP Morgan and Chase Manhattan. And, in the UK, people might be picking a larger named high street bank, although the contagion hasn't come to the UK yet. And so I don't think there's as much movement of money around in the UK as there is in the USA. But, this is a global thing because all the banks are interconnected. So the problem with First Republic Bank is because so many depositors have been moving their money out of it, the larger banks have just come up with a £30 billion rescue scheme where they have deposited a huge amount of money into First Republic Bank in order to try to shore up the value of the deposits that they've got there. So JP Morgan and other larger banks have just deposited a load of money in First Republic Bank, $30 billion. Now, that's incredible. That's an amount of money that I can only imagine, to me. But that's what they've done because people have been stampeding to get their deposits out. And that means that this bank has now got a much higher ratio of loans, money owed to it, than money it actually has it deposited within it. So it's kind of technically insolvent, if you like. So they're doing this to shore it up. I saw a figure there in December 2022. Their loan book was $166 billion. And it's being rescued with $30 billion. But it just shows you, that people are running for the door to take their money out. So the rescue package of $30 billion is still much, much less than the amount of money that it's loaned out. So if that goes under and this so-called rescue package doesn't work, it's not going to stop all normal customers taking their deposits out because they still think it might go under. We'll see. But if it does, that will be the fifth bank to either go down or have to be taken over, essentially, like Credit Suisse doesn't exist anymore. It's now just going to be eaten up by UBS. And as I said, the bondholders have lost all their money. But, if First Republic goes down, then attention will move on to the next one with the next highest stress level and whatever that is, and then attention will move on again and again and again. You see, but this is all inevitable. It's as plain as day that this is going to happen if you think about it, because what has happened over the last 15 years or so. Of course, we know there was the banking crisis and crash of 2008, where Lehman Brothers went out. So what happened, went down, the Federal Reserve, the central bank of the USA, which, by the way, is a private company, the name Federal Reserve is a bit of a misnomer to try to get everyone to believe it's part of the government. It's not. It's a private company owned by very, very wealthy private individuals. I'm not sure the names of the people who actually own it, but it's a private bank. But they have so much money, they're the central bank, and they have a special privilege of being able to print money out of nothing and loan it out to all the other banks. So how it works is a mystery. But there we go. That's a whole other issue. But the Federal Reserve sets the interest rates for the central bank interest rates that other banks can loan money from the Federal Reserve, and that rate of interest was kept very, very low for about 15 years. So most of the time it was 0.25%. So money was very, very cheap, and that of course causes inflation. It went up. There was a little blip. It went up 2016 to 2019, but when the lockdown period happened, they put the interest rates right back down again to 0.25%. So they made money cheap again, so they could loan it out, without anyone having to pay much interest on the money they got. So it's essentially money was free. You could get all the money you wanted for free, and then you didn't have to pay much interest back on it, just a rate of 0.25%. So people were borrowing money like nothing from the Fed in the programs of quantitative easing, which of course leads to a massive increase in money supply, which then feeds into inflation. So ordinary people see the prices going up but don't get much benefit from it. The benefit goes to the biggest banks that are right next to the Federal Reserve and can get their money first. I mean, they don't lend money. The Federal Reserve wouldn't lend money to me or you. They only lend money to the big investment banks like Goldman Sachs and JP Morgan and HSBC and so on, things like that, Citibank and so on. So they've put interest rates up very, very sharply and very, very steeply. So over the last 9-month period, they've increased interest rates from 0.25% to 4.75%. So that is a huge increase, and now interest rates are at their highest level since before the financial crash of 2008. So of course this means that people who have got bonds from the Fed and so on at a low rate of being caught out, and it also means that they will need to pay more back if you get a bond from the Fed at the moment. So the interest rates are much higher, and this means then that money is not so easy to get for companies and individuals which are struggling. So it makes prices go up, and it means a lot of people's financial planning has gone right out of the window because they expected interest rates to stay low for the foreseeable future, but they've gone up really, really steeply. And this means a lot of banks are not able to meet their commitments and obligations because interest rates have just gone up very, very quickly. So this is then feeding in to the banking system, and some banks just simply can't cope with it, because if they're overexposed and the interest rates have gone up, this means that it's going to make make them technically insolvent, and then they go out of business. This is what's happening. So you could see this it's as inevitable as anything. It was always going to happen, because you could see interest rates are so low for so long. People overextended themselves, and now when the interest rates have gone up, they can't pay the money back. I thought this was going to happen. So myself personally, I don't have any debt. I don't have an awful lot of money, but I don't have any debt to anything. So I'm not. I don't have to pay back higher interest rates if the interest rate goes up on the debt that I've got to a bank. But some people, some institutions and businesses are going to be caught out. A lot of people are going to be caught out by this, unfortunately. And it's not just the USA. In the UK, the Bank of England has raised rates precipitously, and so has the ECB in the Eurozone as well. So we can expect more banks to go under simply because the interest rates have gone up so sharply and so steeply that there isn't anything that they can do to actually meet their commitments anymore when they have much more interest to pay every month, if that is the case, if they need to roll over their debt, and they can only do it at a much higher interest rate than they had before if they're in debt. This is the issue for a lot of people, a lot of businesses, and a lot of banks who are themselves businesses that sometimes can't meet their commitments as well. Now, back to the FSCS, the Financial Services Compensation Scheme. So we're told that if you have a deposit account and you have less than £85,000 in the deposit account, it will be protected. Now, in theory, that's true. But I did a bit of research here, and I've found from one figure that the total amount deposited in UK bank accounts is 3.5 trillion. So £3,500 billion is the total amount of deposits in UK bank accounts, which is still more than the national debt. The national debt that the government has built up is now 2.5 trillion. Bank deposits at 3.5 trillion. But will all of that money be protected? Well, of course not, because some people have got much more than £85,000 in a bank account. Now, I don't know how much of that 3.5 trillion is in bank accounts with less than £85,000 in it. But, let's assume that it's just 10% of that money. It's probably more, but let's just assume that of that 3,500 billion in bank accounts, only 350 billion pounds is protected. That's still an awful lot of money, and that still means that ordinary people like you and me and small and medium-sized businesses might be protected. Even if I'm pulling the figure out of the air, it's just a guess, an estimate, but say 10% of bank deposits are protected. Well, what that would mean if there is a total banking crash and they all go under in a domino effect, 90% or whatever, probably a lot of that would just be gone. And it's not coming back. It would just be gone, and then whoever picks up the pieces after a banking crash happens would get that money. Some of it would just be destroyed and gone forever into a black hole. But let's say, for example, 350 billion was protected apparently by this Financial Services Compensation Scheme. Now, I last heard that the amount of money in that scheme was about £500 million. So nowhere near enough to pay out 350 billion if only 10% of all deposits were protected. So we're told that you're going to get your money back by this protection scheme, but there isn't enough money in it to pay everybody out if there was a domino effect and all the banks went under. Now, I hope that doesn't happen. I don't want this to happen. I'm not a big fan of banking practices and what investment banks do, but it would be terrible for ordinary people and small and medium-sized businesses if there were a banking crash, because even the deposits that we are told are protected would not be fully protected because there isn't enough money in the scheme to pay out if big banks went under. I mean, let's just think of one big high street bank. There might be, say, £10 billion of deposits if one big name bank went under, for example, that is a well-known high street bank, FTSE 100 company. I'm not going to name any, but just say that one of them did. There still wouldn't be enough money to pay out for one of them in the compensation scheme. There might be enough money to pay out if a smaller bank went under or a small business building society went under, but not if a big, huge bank went under. The government would have to step in and borrow some more money to pay the compensation scheme. But if everything is going under, would they still be able to borrow money? I don't know. So you've got to be very thoughtful about this. Now, again, this is not financial advice. I don't give out financial advice. I'm just thinking, for myself about what I'm going to do, and just pontificating about what might happen if there were a domino effect. And same in the United States, where they say all deposits under $250,000 are guaranteed, and they've been able to step in for Silicon Valley Bank. But what would happen if First Republic Bank goes under, and then a bigger bank, and then a bigger bank, and a bigger bank goes under? Would they be able to pay out the money in the USA? Probably not, because if everything went down, there wouldn't be enough money to pay to cover all the deposits. Clearly not. When you think of the amount there certainly wouldn't be enough to pay out 3.5 trillion, which is the total amount of deposits in UK banks by personal and business accounts and investment accounts. So be wise with your money. It's up to everybody to decide what they do with their money, but just think about these things and be wise at the moment while this is all going on. So I hope you are blessed and that you're not affected by any of these banking mishaps at the moment. And but we're in stormy times with banking and finances and the economy. And this is because of mismanagement and poor decisions that have been made over many, many decades. The Western countries have borrowed more than they've taken in. They've got more national debt that's been piling up almost every year for the last 50 years, which has caused inflation. The banks many of them don't have enough deposits in there to cover their liabilities, and then people can move their deposits out in a second with the technology that we have today. You just click at the keyboard and you move your money from California to Singapore or the Cayman Islands or wherever, and just like that, it's moved, and a bank can go down in a day if there's a stampede for the door. So these are the times we live in. Probably there will be more banks going down. I hope it doesn't affect ordinary people. That's the issue here. But be wise. Okay, enough said. I've been talking for nearly half an hour. I hope you've enjoyed this and it's been informative. Okay, anyway, I'll be making some more videos about some other issues later on this week as well. Okay, God bless you all.